Hi, John. How are you? So nice to see you again.
Bogumil, I'm so glad to be here with you again today.
So this episode is different. You want to tell us why it's different?
So I'm here with you. Bogumil Baranowski of Talking Billions podcast fame. Uh, and we're going to turn the tables. I'm going
Uh-huh.
to be the host of your show today,
Ooh,
asking you questions. And I just honestly hope that I do you and your wonderful podcast justice.
thank you. Well, I've been looking forward to this. We spoke so many times, and you've been on the show twice. And I had a feeling that we could have a lot of fun if we switched it around a little bit. And I'll let you ask some hard questions, and maybe I have some answers.
Let's do this. One of the things I like to learn about people is their process and what
Uh,
their day looks like and how they spend their time. So, what does your typical day look like? What time do you normally wake up? What time do you normally go to bed? And what do you do in between?
I try to have some fun in between, but I think it
Good.
changed over the years. And I feel like my days have evolved and became more what I like them to be in the last, 5, 10 years, I think. And I wake up early, like historically speaking. So I'm up at around 6:15, and I wake up without an alarm clock, which
Hmm.
is a new experience the last maybe 5, 6, 7 years. Before I would need an alarm clock, so I don't know what that says, but I think I'm more at peace. I'm not in a rush. I
Yeah.
think it's time to wake up, and I'm up. And the first few hours are my hours to just get going. We usually go for a walk
Hmm.
and spend time outside if possible, if the weather allows. And wherever we are, if we're traveling, if we're on the road, we always want to have that first hour, Megan and I, to spend walking. And we've done a lot of walks over the years. And I think walks, especially if you're in a couple, I think are very helpful because it's that time for you to compare notes, talk, listen to each other, and you're in motion. We would walk through Central Park over the years many, many times, and I like those loops in the park where you have really nowhere to go. You go back around the pond again and again, and when you can forget about the direction, you can focus on the person and the conversation. And my day usually ends around 10 o'clock, not too late.
Hmm.
I'm in bed relatively early, and I finish with some reading. I can't go to sleep without reading. I don't know what that says about me, but I need to read a few pages of something. And I have so many books, materials, I don't know, essays that I have open, and I want to read a few pages from any of them. And it puts me to sleep, and I'm more comfortable, and it's a nice transition. Throughout the day, John, the important time for me is deep, deep focus, having big blocks of hours where I can commit to something, whatever it is, and have no interruptions. And I think that's the biggest secret of my day. And I do my best to schedule my day, my week, my month around having as many of those as possible. I feel like it's a privilege, it's a luxury, but it's also where the magic happens.
Yeah.
Whether you do stock research, and you and I spoke about it a lot, if you tell me, you have 15 minutes, can you take a look at it? And we've all been in that position in some career. I think I can only do that much in 15 minutes, but if you give me 4 hours to actually sit down and look, I can add a disproportionate multiple of value if I have this open-ended time to work. So I'm trying to find those blocks of time throughout my week. And now, I invest, I run an investment firm, I have my podcast, I also write, and I try to have big, big portions of my calendar that are freed up. People might think that I'm recording every day, but it's not the case. I have kind of sprints where I record, 4 interviews in two,
Hmm.
3 days, and then I have a week or two of nothing, and then they get released every week. But I want to make sure that I have an entire Wednesday or an entire Friday when there's nothing on my schedule and I can actually sit and work. So this is my routine, and I try to maintain it as much as possible. The one thing that I would add that I think you might find helpful, and you probably do the same, is your life has to be organized, or mine has to be organized with some systems. Like the podcast, for example, And it's the same with anything else in life. If you do like a one-off episode every quarter, it's different. But if you want to do one every week, you have to have a system. So I have a scheduling app. I have my notes. I have my questions. I might have read the book 6 months ago, so I have new notes about the book, so I can be more prepared for the conversation. But it's all within some sort of a framework. And it's the same with stock research. I have a list of businesses that I respect. I have a schedule around them. I go back to them. I look at them. It's a repeatable system that allows me to flow through my day, week, month, and the year. And I think that's very, very helpful. So it's not as random as it may seem, but there's an order to it. There's an order to the day, there's an order. And it's funny because the more order you create, the more blank spaces you can have, right? Like if everything is so organized, then you can have that 4-hour block when nobody needs you and you can just focus.
I took so many things away from that. So first of all, you can't go to bed without reading a little something. It's become part of your nighttime routine.
Yes.
I love that. I read so much just personally throughout the day. I stop reading when I don't have great eyesight. And so I stop reading when my eyes actually start watering. That's how I know I've strained the muscles in my eyes so much. And so I actually don't read right before I go to bed because I've read so much straight throughout the day that once I close the book or shut off my screen, I don't read anything else the rest of the day so that I can rest my eyes. And I fall asleep watching something mindless on TV like Seinfeld, which I love. It makes me laugh. I don't have to think about it and pay too much attention to it, but I can still get enjoyment out of it, and that's what puts me to sleep. I do want to say quickly about your walks because those are so special to you. And I also walk every day, and my walks are so special to me. My girlfriend lives out of town. We're in a long-distance relationship, and so when she visits me here, or when I visit her in Colorado, we walk together, and that's our happy place. That's our most enjoyable part of our day, both of us, when we're walking and talking to each other. But when she's not here, I think it's fairly unique way of walking, and I didn't always do this. It's fairly new to me. I don't bring any electronics. I don't have a phone. I don't have earbuds. I don't have a watch tracking my steps. And so people say, well, how do you know how many steps you're taking? I used to have a watch, and I also go on a loop, Bogumil, and so I know the loop is exactly 1.8 miles, and I know that my house is exactly 6 blocks from the park. There and back is exactly a mile. I've measured it all off, so I know that I'm doing 5 miles every day. I know how many steps I'm getting because I used to measure it. I know what zone 2 kind of feels like, and so I don't bring anything. I don't listen to anything. And I just let my mind wander and rest. And it can be everything from I will count. So the park that I walk around is full of very old oak trees, New Orleans oak trees. It's too many to count, but I have picked out my favorite oak trees. I've picked out the ones that I would like to climb if I was a kid again. I count the number of magnolia trees because there's not as many magnolia trees. But then I also just let my mind wander. And some of my best doc ideas have come on those walks when I don't have an agenda. I just walk. I do the loop. I don't have to worry about direction, like you said. And it's just really, really enjoyable. But moving on. So you mentioned you do a lot and you accomplish a lot. You manage stock portfolios for wealthy individuals. You've published 3 books. You're a TEDx speaker. You have a truly wonderful podcast that you release, episodes weekly.
Thank you.
Sometimes it seems like even more frequently than that. You're an investor. You're a businessman. You're an entrepreneur. You touched on some of this, but how do you get it all done? Specifically, like, what apps are you using? What scheduling software? any processes that you've put in place or systems you've put in place to help you get it done? And maybe also, does anything get crowded out? Do you have to eliminate anything from your day or
Mhm.
from your week in order to be an investor, be a businessman, be a podcaster, be a writer, be an entrepreneur?
That's a terrific question. I think it's about prioritizing, and I think in a way it's better to have too many things so that you have a chance to choose. It's almost like the stock portfolio, right? You want to have more ideas than room in the portfolio, so really the best one makes it in
Hmm.
than too few. And I think it's been 20 years of experience, and I started with a legal pad and a pencil, and
Hmm.
like a lot of people, that my work routine didn't really differ much from the people I started working with that were working since the 70s or the 60s, just a pencil. And then I think I continued to streamline it and improve it. But I think having a list of things I want to accomplish in the day, that hasn't changed. It's just how I get there has changed. And John, I feel like if you can save a few minutes here and there throughout the day, you're getting hours in a week, and then you're
Yes.
getting days in a month. And sometimes you feel like, oh, I can do it by hand. But if this is automated, or if it's done without your participation, it's a huge difference. For me, the big thing that you brought up is scheduling,
Hmm.
because I schedule both the podcast recordings, but then I speak with quite a few members of the audience now and then. I try to reserve a block, and I have 10, 15 minutes, and maybe I take too many of those calls, but I'm having so much fun with it. The stories that people tell me, and it becomes a two-way street where
Yes.
I can learn more about who is actually listening. Why do they care? Why do they keep coming back to the show? So I used Motion with an M
Hmm.
to book blocks of time, and you can organize it in various ways. I know that there are other tools, and I used other tools. I like this one because I just send a link, and people know, depending on the type of a request, if it's a recording, if it's a call, if it's a work call, a client call, it falls into different calendars, and I don't have to go back and forth with people about the time and rescheduling. And if they have to reschedule it, they do it without me. So it's almost like a power assistant
Hmm.
that's doing all the work without any errors, because they look at the calendar, they choose the time, and if it works for them, they pick the day, and so on. And that definitely saves, I want to say, like 5-10 hours a week of
Oh,
just scheduling and rescheduling. I think
definitely.
I think would be fair to say. So
Yeah.
that's been a real life changer. Then the second thing is that taking notes of all kinds, taking notes about earnings calls, taking notes about the stock, taking notes about my thoughts about certain investments or changes I want to make in the portfolio. I streamlined that as well, and I used Word before, but I use Notion with an N these days quite a bit. And I'm sure there are other tools, but it's very customizable. You can really change it around and build databases around it. It's not very complicated, and I don't know if you use Notion. Are you familiar with Notion?
I am familiar with it. Yes.
But it works like my brain in a way. Like I feel like any brain you bring to it, it will become whatever you want it to become, and that's what I like about it. That if you like a list, it can be a list. If you want a table, it can be a table. You can change views. And sometimes I want to look ahead, what kind of recordings I have scheduled, what's coming in the pipeline, and all kinds of views to navigate that. But I can organize my stock research, what I wrote down and when, what kind of actions were taken, and so on. So it really helps me. But all those things add minutes and hours to the day that can be used in a more productive way. And
Yeah.
I'm very excited about the future, and I feel like all the new tools that are coming, people think that those new tools, AI, that they will replace us, and maybe in some way they will replace some roles, but I think it's like a superpower that can actually streamline a lot of things. And some of the things are very repetitive, and I think there's a lot of room for improvement in processes and automation and getting things synced and linked up between calendar, email, and scheduling. Because at the end of the day, where do I add value? Where do we add value as investors, right? So to me, it's two big pieces. One, I want to have a lot of time to do actual research, because that's what brought me to this business, and I know that you can relate to it. I love looking at ideas.
Mhm.
for me, when people say, is this work? I don't know. I mean, it's Saturday and I'm looking at an annual report because I came across something I want to double check. That's interesting. It looks like they're taking a different direction. I'm intrigued. I want to look at it. And then the second half is I want to have ample time to be available to clients. Mm-hmm. If they need something, if they want to talk about something, and these are priceless moments where I want to be available, sometimes for an open-ended hour or two, where we can talk. And if I can free up as many hours for both of those, I think my clients will be happier, and I'm happier, and I feel like I'm more productive and I'm adding value instead of spending time going back and forth, scheduling one appointment where this doesn't work, that doesn't work. It can really take up, 3 hours of your week just to reschedule one appointment.
Yep.
So
I've been there.
Yeah, you've been there, right? So I think having that moment when you realize, okay, this took 7 minutes. What if it took 5 seconds? Mm-hmm. And it's been my mindset ever since I started working in this industry. I remember in my early roles, I was the one that introduced the firm where I was to a new software. And one of the partners, I don't know, the executives came up to me at the end of the day and he asked me, what is it that you can do with this new software? And that was like 18, 20 years ago, that he couldn't do with a pencil and a legal pad. Yeah. and I said nothing, but I can do it in a fraction of the time.
Yeah.
And I think he got it, but I realized how much resistance there is to any change. And I don't want to be myself in a position where I don't continuously learn and change. That's why if there's a new tool, if somebody mentions something to me, I'm always intrigued and I want to learn how else I can do something that could save me time. I think, John, at the end of the day, time is the most precious asset that we have in so many ways, right?
Yes.
So if I can recoup that hour, I'll take that hour any time of the day.
What is your perfect work environment? I mean, like, are you at a standing desk? Are you sitting down on a leather couch? Do you have 2 screens up, 1 screen, 3 screens? Do you have music on in the background? What's your perfect environment to be productive and be the best fiduciary you can be to your clients?
Over the years, I've had everything that you described. I had multiple screens. I had all kinds of chairs. I was standing at a desk at some point. Mm-hmm. But I think the environment that works the best for me is no different than my college environment. I would grab my books that I was reading at the time for an exam, and I would sit down on the couch or even lie down on the floor with the books against a wall or a cabinet or something. And I would just read. And I was never really good at sitting at a desk. Mm-hmm. I could. It's not a problem. I could. But I never thought that I'm creative. I feel like my whole physical perspective changes. And I actually wrote an article, I don't remember the title, in the middle of the pandemic, how my work environment has changed, that I just grab the reading material and I sit in a different part of the room, or I sit on the floor and I read. And somebody wrote to me, that's exactly how I work. I just grab the material and I read it anywhere. So I have a laptop, I have a single screen. If anything, I have a split screen sometimes if I need to look at 2 documents at the same time. But I feel like having multiple screens and multiple distractions, and I think the word is distraction. It's both, people walking up to you, you're smiling because you know exactly what I'm talking about. And mm-hmm. I mean, how can you possibly look at 4 screens at the same time? And I know people that had more than that. How can you do that? Like, which screen do you choose to look at? Our mental abilities are not there to accommodate that. I had Lucas Miller on the show, who was a neuroscientist, and he was talking about the brain, and he explained how the environment that we have created with a traditional cubicle culture is not helpful to the work we're trying to do. It's a mental work. It's a lot of focus, and it's a competitive business. There are a lot of people looking at the same investments with very bright people doing the same business, similar, not the same maybe. You have to create some sort of an advantage for yourself, and why not be a little bit kinder and have fewer distractions, maybe 1 screen, maybe a quiet room. You asked about the music, and it's fascinating because I feel like I listen and I hear too many things. And I think it's our brain maybe looking out for, I don't know if it's curiosity or danger or both. So if there's a conversation going on and I can hear it, I can no longer read or write as effectively. I can try, but I can't. So I put in music sometimes when I need a solid hour of, I'm editing an article, or I'm finalizing my write-up for a stock. I just want to organize it so it's clean and I can file it away for my own purposes. And then I put in music with no lyrics that's focused, but it's also just a steady sound that doesn't allow me to hear anything else. Yeah. So that definitely helps. And these are the moments where I can make a big leap and finish something instead of hearing anything else that's around me. But I think the word is focus, and I think we have a shortage of focus in our society. And if you can create an environment where you can have a lot of that time that I said before, deep work and actual focus, I think you have a huge advantage. And it doesn't mean that you have to be smarter, faster than anybody else. Just with the abilities that you have, I think you can get a lot more out of the time you're spending.
I agree. I also have only one screen. I can't manage more than that. There's too many blinking lights, too many distractions. I just, like you said, I have one screen. All I need is one. All I want is one. Your environment of sitting on a couch and reading, or sitting on the floor, lying on the floor and not being at a desk, reminds me of my good friend and sort of mentor, Brenton Johns. He's the founder of NZS Capital, NZS Capital. And the way that they organize their office is very intentional. So all of the desks for the portfolio managers are in the middle of an open room. There's no cubicles, so that they can constantly talk to each other throughout the day. But also they have what they call a reading room or a library, and it's very intentional, because some people don't like to work at a desk.
Mm-hmm.
Some people prefer to read in a really comfortable reading chair or couch. Sometimes in a darker room, sometimes alone, sometimes away from the group, sometimes lying on the floor, whatever it is. And so their offices provide that. And I've walked through their offices, and he explained to me that this is all very intentional. And it also gets them away from the screen. There are no computers or televisions or anything in that reading room, in that library. And the environment plays a role. It can facilitate productivity and focus and deep work and all of those things that you were just talking about. Why investing, Bogumil? What is your why?
Well, I think it happened from many different directions to me. And I was fascinated with history, numbers, and people. And when I was going to college, I was just very, very curious. But I couldn't really figure out how I can deploy that curiosity in one singular direction. And I was hoping that I can find a professional way to do it. Not have kind of a dual life where this is my job and this is my curiosity. I thought, how can I find a job where it's all about my curiosity? And you might know the story about Peter Lynch, One Up on Wall Street, how I picked up the book. And I gave a TED talk that you mentioned, and I opened it with that story, how I came across this book in an English language bookstore in Brussels where I was an exchange student. And it was back in the day where you would grab a book and actually sit on the floor and read it, or at least decide if you're going to buy it. And I actually found 3 books at that bookstore. And I rarely tell the story about the other books, so maybe today is the day when I can share more about the other books.
Today's the day.
But Peter Lynch, in that book, One Up on Wall Street, told me that stocks are small pieces of businesses. And to you and I today, it's such an obvious statement. But to me, at, I don't know, 21, this was a life-changing message, because it was right after the internet bubble burst. My professors were burned clearly by their personal experience in the market. And we were not thinking seriously about an investment. career of any kind. We were talking about Amazon as being a disaster at the time, which, I mean, technically it was. It went from $109 to $9. Even Jeff Bezos in the annual letter wrote, ouch. And some of us still remember that time. Mm-hmm. But Peter Lynch told me that you can own those businesses and become a shareholder. And somehow that message really spoke to me, because I thought, wait a second, it doesn't matter if I'm young, if I'm old, what's my gender, what's my experience, where I am in the world, how much money I have. I can become an owner in some of the greatest businesses out there. And those businesses will treat me as well as any other major shareholder, including the founder. That's the aspiration, right? That's the aspiration. We know that not all businesses are as fair, but let's say that's the aspiration. But it really blew my mind and opened my eyes to a whole new world. And I thought, intellectually, it's highly stimulating. I didn't even think at the time, wow, I could make money with it. I just thought this is fascinating as a concept, that I can figure out a certain puzzle. And if I'm right, it's only the market that eventually will tell me, yes, you were right? So you don't have to convince anybody in that setting, but you can do all the work, and you can go as far as you want. You can allow your curiosity to run wild and read. And I like that I didn't even know the words. I learned later people call it the lattice work of mental models and so on. But I thought it doesn't end with the fact that I understand Coca-Cola. I understand the consumer. I understand what it means to be present in 100-some countries. I understand what the brand means. I mean, I realized, wow, it's such an open-ended field of pursuit for my curiosity. The second book that was not far from that book that I picked up was about Alan Greenspan, who was in charge of the Fed at the time. And I was a green student. I was just learning things. And I started reading those pages, and I thought to myself, I don't get that book at all. I don't get it. Because that book said that there's this gentleman somewhere in an office in DC, and he decides what the interest rates will be. And I grew up in a Cold War Poland, the last 10 years of a communist country over there, and we had officials sitting in buildings deciding how much a nail and a shoe and everything else will sell for, what the price is. And I, by that time, already knew how ridiculous that idea is, because how would those handful of people sitting in a room know what kind of shoe John wants, if John even wants a shoe, and at what price John would be willing to buy it, right? I thought it's such a ridiculous, but it was a centrally planned economy. There are books written about it and studies done. But when I was reading that book on the floor of that bookstore, I thought, wow, this is a centrally planned mindset of, you basically have a policy that sets the price of the most important, or one of the most important ingredients of our economy, the cost of money. Let's say it's the most important. At the end of the day, you can't make any single decision. You're laughing here.
I'm agreeing. Yeah.
Yeah, but it's the truth. So I put that book away, and I thought, I don't get it. And there was a third book that I can't locate anymore. And I've been looking for that book, and I can't find it. But that book really inspired something, or planted a seed. And it was a book about a family that remained very wealthy over many centuries. And it was a work of fiction. It might have been inspired by a particular family. But it connected the dots in my head with Peter Lynch's book, because Peter Lynch was a bottom-up, let's pick the stocks that will work. And this book was showing me how I can have a portfolio of stocks that could compound wealth over a long period of time. And I quickly realized that it might not be the same stocks, not the same businesses, not the same industries. We can talk more about it, but there are stories of families that created wealth with one industry. The industry might be no longer with us anymore because of the technological change and consumer preference and so on. Or the glory years are all gone by now. But the family's wealth continued in a portfolio of other businesses. Mm-hmm. I mean, Berkshire Hathaway is one of the many examples where you had one industry, textile, and Buffett chose to go to so many other businesses because he knew that there's no promising future in that industry. And there are many other stories, and there are tales that Adam Mead on this show also shared how the initial capital that went into the textile industry actually came from the whaling industry, which is an even older industry. And so you see how that capital can flow. But anyways, that book really showed me a bigger framework to think about wealth, that it's not just you picking a stock that goes up 50%, but what would a repetitive framework system do to substantial wealth, or any wealth, but it's easier if it's more substantial, over a long period of time? And how could you keep it? How could you grow it? How could you perpetuate that family fortune? And that's the work I ended up pursuing, and that book planted a seed. And it was fun to look back and see that was the first time I read anything like that, that wealth could be something that could outlast you and I one lifetime. It could be multi-generational.
So much there. So One Up on Wall Street was also the first investing book I ever read. I was also a student. I think I was 19. And that's the book that planted the seed in me. It was one of only maybe 2 times in my life that I've literally experienced a light bulb or a switch going off in my head. When I read that book, I realized that I understand this. All the concepts made sense to me. And the other light bulb at the same time was, I think this is what I want to do with the rest of my life. I can't imagine if the first finance book or investing book I ever read was not Peter Lynch's One Up on Wall Street. If instead it was about charting and technicals, which is fine, great skills to have. I just don't know if those would have spoken to me in the same way. I don't know if I would have understood the process behind technicals and charting and swing trading or day trading and all of that stuff in the same way as long-term fundamental investing and thinking about it as ownership in a business. The book spoke to me so clearly and strongly that when he published, or when I came across his other 2 books, Beating the Street and Learn to Earn, I read them immediately. And they had similar impacts on me. If you ever come across that 3rd book, please let me know so that I can read it again. And just the last thing I want to say is, when you're talking about generational wealth and how a family can create wealth in one industry and keep that wealth, maybe grow that wealth, but at least keep that wealth, even if that industry becomes obsolete because they invest in a portfolio of assets across other industries. I think that just personally speaks to the importance of managing businesses on behalf of their shareholders. And if the management team cannot find high return on invested capital reinvestment opportunities or intelligent acquisitions, then that capital should be returned to shareholders in some way so that those shareholders can redeploy that capital into more productive, modern, growing industries. And that's how innovation happens. That's how capital markets function. That's how we move from whaling to textiles to everything else beyond that, is through this constant redeployment of capital into the highest return opportunities. And so I think the story speaks to managing businesses on behalf of shareholders and trusting that shareholders know what to do with the capital once it is returned to them.
John, it boils down to what we're trying to do here. And I think it's fascinating to see this transition where I thought it's all about picking stocks that go up, because I think that's what gets us hooked in investing. But why we stay, it's the bigger why. That's why I think there are two layers to it at least. And thinking of wealth as something that you can build, and thinking of wealth as something that can provide options and freedom and choice and so on, and even peace of mind. You know, the clients I work with, the money is deployed, it's invested, it's in a portfolio of stocks, and the fact that it's there, and they might not need it, might not touch it, which is a perfect setup for a long-term investment strategy, but the fact that it's there, it has a huge impact on their day-to-day choices, decisions, or how they even feel about the world, that just in case it's there. And it's an intangible value that it has to them, that it's sitting, waiting in case they need it. And that kind of capital can be committed over the long term. I want to emphasize one thing that I think gets missed in both how we study finance and then get experience in finance. And I think it's not just the psychology, but the emotional side of it. Like, there's no money in the world that doesn't have an emotional charge. You walk down the street later today and you're going to find a penny. And that penny's going to put a smile on your face. It has power. You know, even a penny has power. And you're thinking, I'm feeling lucky, right?
Exactly, yep.
Every single moment we interact with money, it has an emotional charge. So think about a penny. But think about growing up in a family that has a business for 3 generations. And their identity, their name, their story is tied up in textiles, for example. It's not just a financial decision for them to say the returns are falling and we should be in a different industry. I think we admire Buffett, but Buffett had a huge advantage stepping into Berkshire, and I don't think he was really thinking about becoming an owner of Berkshire. We both know the story how it was more by accident that he became such a meaningful owner of Berkshire Hathaway. But he had no emotional baggage in a way, no ties to the textile industry and the story. I think he's a historian, so he likes the stories. I think he loves the stories of the businesses he buys, but it's a different kind of appreciation for the story than feeling that my family's identity is in textiles, right? It's a very different. So to switch out of that industry is a huge step. And I see family after family that have done it in the recent years, and I get to work with them, or had done it in the past, and tell me the story of how they parted with the original business and how it's been a portfolio of holdings since, and so on. But every family that wants to get past that point has to go through this emotional journey of, you know, giving up the initial business and continuing with the stories and with the legend and with all those memories into the next stage. And sometimes you can keep the name of the new holding company that has a reference to it and so on. There are ways to do it, and preserving stories and telling the kids where the money came from and so on. But I think it's very tricky. And there are very few industries. I wrote a book, Money Life Family, where I studied both the families that I knew, that I was exposed to, but also the families that I studied and researched over the years. And it's all, you know, I mention only the names that everybody knows, the very well-researched names, and everything else. After you listen to so many stories, they start to rhyme, so you get to see the same patterns.
Yeah.
There are very few industries where the family could have held the same business for 100 years. And these are the businesses, as you can imagine, that are subject to the smallest change, evolution, you know, confectionery, alcohol, beer. And it's a very short list. Most of the industries went through so much change in the last 100 years, right? So if you held railroad shares, stocks in the late 1800s, that wouldn't be the place to preserve your wealth. And in Europe, some heavy industries went through massive change and nationalizations and so on. So there are so many places where you just could not there was no way to hold on to your wealth in that industry. So transitioning out, and then the next journey begins, and it becomes a truly multi-generational pursuit where you can compound that wealth and it can serve multiple generations. I like this idea, John, of providing a situation or setup or a mindset where the next generation doesn't have to start from zero. It doesn't mean that they have to be born into billions. I mean, I wish that to everybody, of course, but the fact that they don't have to start from zero. And it's especially personally important to me because I grew up in a country, in Poland, that because of its location and the history, it was not a place to preserve and grow wealth. You had 2 world wars in the last 100 years. The country had no independence between 1795 and 1918. And then you had almost half a century of communism where there was no private ownership, right? So if the wars didn't burn it, destroy it, take it away, then the 45, 50 years of communism definitely helped you part with whatever you had, if you had anything. And there was no stock market between 1939 and 1990s because of World War II and then communism. So there were very few ways to preserve wealth. Actually, the dollar was seen as gold. And actually, at some point, holding the dollar in Poland was illegal. You know, like how holding gold in the US, people forget it, but there was a time when holding gold was illegal as an individual. And in Poland, holding gold dollars for other reasons was not convenient for the government. So the fact that you could have wealth that lasts multiple lifetimes, it's something that I find as a huge aspiration. If you do create the wealth, how can we make sure that it lasts? So to me, it's not just that somebody got wealthy, but now let's sit down and think about how we can create a framework, a system for us to perpetuate that. Would you like that? Would you be interested in that? That's the kind of questions that I want to propose. And then you come from such a more relaxed place when you know that you're managing something with an infinite time horizon, instead of thinking of I have to be a winner in every monthly rating or a quarterly rating or an annual rating. You're thinking of a family that has substantial wealth is not considering monthly movements of the portfolio. No, that family is thinking, can I double it? Can I double it? Can I double it? And if you can double it every 5 or 15 years, let's say, it's going to become a very substantial pool of money if you don't make some unnecessary mistakes on the way. It can really serve you and the next generation and the generation after. To me, it was an eye-opening experience moving to the US and meeting some people that have had some mineral rights in the family that date back 4 or 5 generations. It's something I can't imagine in Poland, and in many parts of the world. Poland is my own personal experience, but I meet people from all parts of the world that have had that experience of having their family, confiscated assets and lost for various reasons, or they had to move locations and so on. Those stories repeat around the world. To have a place and environments and a setting where you can perpetuate wealth, it's a huge blessing.
In our environment, in the stock market, long term, I'm doing air quotes, long term is considered if you have an investment horizon of 3 to 10 years, for example. But that's nothing compared to your horizon, managing generational wealth. I mean, it's almost an unlimited horizon. It's unbounded, Bogumil. And I wonder does that change the benchmarks? Like, when does outperforming an equity benchmark matter as much when the time horizon is infinite?
So it's a terrific question. I asked that question to a couple of people on my podcast. And I said, imagine for a second that the benchmarks were never invented.
Right.
That it never happened. We never organized the benchmark because benchmarks are man-made. Let's remember that. They were not in the Old Testament. They were not in the Bible. They're man-made, right? People got together and they wanted to keep track, probably for marketing purposes, what some sort of a representative group of stocks is doing, the Dow Jones, and then later we have so many more, I lose count. So for a second, with the pursuit that you have in front of you, and I asked a friend who's based in London, Christian Billinger, who manages his own family money, and he can really relate to that given the overlap in what we're trying to do. And I said to him, and I asked myself, if the benchmarks were not invented, would that change anything that I'm doing? And the answer is no. Like my goal is to grow wealth over time.
Yes.
Now, this could be a 5% year, this could be a 20% year, and then you tell me that the benchmark is up 27. Well, then I have 1,000 questions. What's in the benchmark? Now, you and I will agree that this benchmark looks very different today than it looked 5 years ago or 10 years ago, right?
Yeah.
And in this point in time, actually, there's a very high overweight of a very handful of stocks in the benchmark. So if you don't own these, you're in trouble compared to the benchmark, which also means that at some point, some things will reverse. That's how it usually works.
Yeah.
But anyways, the point is, what are you really trying to do? And I think a bigger question past the benchmark is what you don't want to happen, what we would like not to ever happen. Like when you think of a family wealth, whether it's meaningful to you. So I don't want to put an amount on it, but it's meaningful to you and your family. What you would not like to happen. And it's an obvious answer if you really think about it, and you wouldn't want to lose it. You wouldn't want to put that capital in danger of a total loss.
Yeah.
And here I say, even 95%, 90%, it's almost a total loss, impossible to recover. So what is it that we can do to avoid that? And when you have a portfolio of stocks that are thoughtfully researched and chosen and diversified, and you and I spoke about it quite a bit, how there's so much that I would avoid, and I call them the zeros, things that could go to zero that I don't want to have in the portfolio. So you put in layers and layers of systems and checklists and frameworks that allow you to eliminate certain things. When I sit down with clients, I say it's not just the stocks that you see, but it's also all the other ones we chose to say no to.
Yes.
Right? For many, many reasons. And you can put them in buckets. You can say one of the buckets is high leverage, one is questionable management, one is secular decline. Like to me, these somehow they happen again and again in some shape or form. If there's too much leverage, then a company looks like a hero when things are working and is putting capital in, equity capital in huge danger if things are not working out. We've seen that happen time after time again. Questionable management, it's hard to evaluate, but if there are people that you don't trust for some reason, or they over-promise and under-deliver, and I don't mean fraud. I mean, there's outright fraud happening too, but just not people that you want to be partners with, then maybe you don't want to have that stock in the portfolio. And the secular decline, it's a tricky place, especially for value investors that want to get a deal, because some cheap stocks will get cheaper and cheaper and cheaper. And I think it's a trap. And I think it's never been, I think it's harder than ever before because of the change that we're seeing. I think companies that were not doing so well or were in that slow decline mode for a long period of time, now I think it will be happening quicker with the consumer shifting quicker, and it's just a much more accelerated phenomenon these days, which I'm very curious, watching and analyzing and observing how just because a stock is cheap, I want to know more. And it's that dance between temporary and permanent, and temporary issues create a buying opportunity. Permanent change creates a value distraction. So you have to be very careful, and it's easier said than done, but I think we have to pay attention. And I think that's why active managers have some advantage here, that they don't have to watch those things go to zero and sit in their portfolio. They can part ways with it. But that's how I look at it. It's a more nuanced way of thinking about what we're trying to accomplish. And if the goal is to grow wealth over time, a lot of things become secondary. The best stock of the month, who cares? The index had a big month. It doesn't really matter. You're building something that's, what kind of decisions you could make that you would judge, 50 or 100 years from now, or somebody would judge for you that they were really good, and what kind of decisions you can take. And I think, John, the biggest thing here is that when we say that it's a competitive industry, when you and I are trying to guess if the market will close up or down today, it's a 50-50, basically, historically, coin flip, right? Like we can bet $1. If you start to extend the time horizon, you and I know that, first of all, the odds improve that you'll make money over time. And second, there are fewer people really competing against you. And I think that's the point you were trying to make earlier, and I see how many people are paying attention to quarterly results. I pay attention to them because I want to know how the business is doing. I'm not paying attention to them to know if it's a beat or a miss. I don't care. But if you can take a 5 or a 10 or a 20-year view, you might be the only person in the room. So we think it's a very competitive industry. It is if you're trying to guess the next quarter, but if you're here for the long run, and I mean a true long run, there's just a handful of us that pay attention.
This is amazing. So the numbers say that historically, if you hold the S&P 500 for 20 years, you have a 100% chance of making money. Those are the historical numbers. But like you said, if you extend your time horizon, your chance of making money goes up to near perfect, 100%. Excuse me. So you've said so many times today that you want to preserve wealth and that your clients, they're really fortune keepers. They want to keep what they have. They don't want to lose it. That's their most important criteria, is they don't want to lose what they have. And so you have this beautiful philosophy of avoiding zeros. And you told us how you do it. You start off by eliminating the things that could potentially lead to zeros. Too much debt, mismanagement, and businesses in secular decline, or businesses operating in industries with secular decline, deteriorating moats. And then you also said, there's a second part to that, that you also want to eliminate the things that shorten our time horizons, right, Bogumil? Because like leverage shortens your time horizon.
Mm-hmm.
Margin shortens your time horizon. Options shorten your time. Options have a date, right? They have a date attached to them.
Mm-hmm.
So anything that has this, that could destroy value, like too much debt, like mismanagement, like businesses in secular decline, or anything that could shorten your time horizon, you can choose to avoid if you want to.
Mm-hmm.
You can choose to avoid those things, and that improves your odds of preserving and growing wealth over a lifetime, or
Mm-hmm.
over multiple generations. And I think it's such a beautiful concept when you stack the odds in your client's favor that way. By eliminating all of those things. So my next question is, what do you look for in a stock once you've eliminated all of these things?
Broadly defined, I'm looking for durable quality businesses. And I want to take a step back just to bring it to basics. Why would you even own a business? And I think it's a good question to ask, because we get lost with the complexity of the process of stock research and stock selection. Why would you own a business, right? And let's forget the stock market for a second, but you and I are passing a gas station. It's a hugely successful gas station. There are cars there always, and there's a store, and there are lines, and it's a popular place, and the staff is nice, and it looks like they're doing very well. And you and I walk up, and we ask the owner, can I buy a small stake, 10%, 5%? How much would it be, right? Because we see a business that's doing very well, and we can look at the numbers, right? So there are all kinds of ratios that you and I are familiar with, and I'm sure the audience is also familiar with. We can look at the margins, we can look at the cash flows, we can look at how much the business needs to grow, what kind of rates it can get. Can I get some cash back as a shareholder, or is it getting reinvested? So we're getting a feel. And when I say a quality business, it's a business that makes money. Keeping it simple, right? Like, why would you run a gas station? It's got to make money. And if it makes money, then what do you do about it, right? You can open another gas station. Hopefully you have the secret formula to find the right spot in every town, right? That's the chain model that we've seen, and Peter Lynch talks about in his book. You repeat the same success and you reinvest at a nice rate. So you want a business that's, on one hand, already good quality, meaning makes money and produces cash flows. On the other hand, a more dynamic view is that, can these guys repeat it? Can they do it again and again and again, and has an open runway? I've been thinking about this bigger idea of a dream stock, and I wrote down 3 words: ubiquitous, global, and profitable. And
I'm definitely stealing that. I'll give you credit, but I'm definitely going to add it to my watch list. I mean my checklist.
It will become an article at some point, hopefully
Yeah.
soon enough. When you look around, there are certain goods and services that are ubiquitous. They're everywhere somehow, right? And that's a dream, that's an aspiration. Not all the holdings will meet that, and some of them will meet 2 out of the 3, and so on. But you would love a service it's everywhere. You can't live without it, and you know people that can't live without it. And I'm not going to name anything, but I'm sure there are certain services and goods, and you and I would agree that you have to have it. The aspect that I like that it's global, and it's a revelation of probably the last 50 or 70 years, but mostly probably the last half a century, that if a concept works somewhere, can we have it coast to coast? And Peter Lynch also writes about it in the book, how you would have a hotel chain, a restaurant chain, I don't remember, but a bunch of different ideas. And he would say, well, it works in Massachusetts. Would it work in Ohio? Would it work in California? Okay, if it does, then it's not 100 locations, then it's 2,000 locations. That's how Peter Lynch put it in the book, one of the layers. But it's these days we can go global. And it's fascinating to me that, and I talk about it quite a bit, that I'm very US-centric and US biased. I became American as an adult, and most of my investing has been in the US market, and I have huge affection for the US. So bear with me here. But I feel like US companies have this secret but huge advantage that if the concept works in the US, and it's such a big economy by itself, but it's also very diversified. It's a variety of people, variety of consumers. So if you can have that concept and it works in the US, can it work globally? And somehow US brands, right off the start, at the beginning, they have this huge advantage that people aspire to use those and have those. I'm just an observer. I'm just looking at the world, and I see how people just want it because it's an American brand, whether it's clothing, whether it's an app, whatever it is. And other countries have not reached that. There are exceptions. I know there are some Swiss companies, and then there are some based in Asia that have that, but it's a handful of companies. But with the US, if a company becomes a national brand, it becomes a global brand, then it has a much bigger reach. If you can sell to 150 countries, and it's even better, I think it's an additional sweetener, when you get better margins outside of the US than in the US. Mm-hmm. And it does happen, and there are companies like that. So you have the ubiquitous, you have global. The profits part, it's kind of a given. Like if it doesn't make serious profits proportionately to the business, or can do it in a foreseeable future with some healthy cash flows, without much of a reinvestment, I kind of lean towards companies with less of an asset-based asset needs. I feel like the future will be asset light, distributed, dispersed, and I think that's where the huge leverage will happen. You talked about financial leverage, but there's operating leverage and all other kind of leverages. These companies, I think, will win at the end of the day, and I'm looking for long runways at the end of the day, right? Like when I'm looking for a business to own as a portfolio of, 30, 50 stocks, let's say, for a family whose money I manage, I'm looking for those open-ended runways. And I wrote a piece 2020, I called it 20 stocks for 20 years. What kind of a business would you like to own for 20 years? And here I meant not just a business that will be around in 20 years, but a business that deserves my time, deserves the wait. It's a huge difference, because when I give talks and I tell people, if you could hold stocks for 20 years, what kind of stocks would you own? And people give me stocks that have been around for 200 years, are growing at 1% a year, and they will be around probably in the next 100 years because they're in industries that are subject to limited change. But I say, are they worth the wait? I completely reframe the question, right? And I want a business that, because it's ubiquitous and global and has profits, it can be a multiple what it is. And it's building on Chris Mayer and Phelps' ideas of what are the stocks that could go up 50 or 100 times? And it's an aspiration. Not all my stocks will go up that much. Some of them will be total duds and will go nowhere. We have to be honest about it. But if you can find some of those, I think they will make a huge difference. When I mentioned that I don't want to create an impression that we're relying on a handful of big winners, I'm showing that it's what I call a repeatable, reproducible mindset of looking for that kind of quality out there. buying it in a disciplined way, which is something we can talk more about. Not just identifying them, but having the patience to buy them when they're down, cheap, out of favor, which is one of my mantras. I'll put it on my list, and you and I talked about it, and I know you can relate to that.
Yep.
Everybody can point quality, but very few people can actually wait to buy quality. And I think that's where the difference happens. Not only buy it, but actually hold it. I like to say that everybody can buy a stock, but so few people can actually hold the stock. And having the long-term mindset allows you to actually hold it. So many people are forced to sell shares because they have to rebalance, because they have to manage to a benchmark, because of the client preferences and so on. But if you can actually hold it, some really fascinating things can happen. And Peter Lynch had this saying that you put $1,000 in stocks, in the worst that can happen, you lose the $1,000. But if you're right, you make 10 or 20 or 50,000. Think about the asymmetry of outcomes here, right? Like if you're right, some of those investments could be a multiple of what you put in.
Absolutely. Yeah, I mean, that's the thing that's most attractive about stocks is they have asymmetrical upside potential. So, you simplified it down. First of all, that was a masterclass. That was a masterclass on what you look for. First, you said you want durable quality, and then you described durable quality as ubiquitous, global, and profitable. But then you said you wait. You identify what you believe is durable quality. You identify what a business that you believe to be ubiquitous, that can scale globally, and that is highly profitable, that has a long runway, as you said. But then you wait. What are you waiting for? Are you waiting for that attractive valuation that you think can lead to attractive returns over a long period of time?
So I have a list of companies I'd like to own. And people tell me, how do you think about deploying your time? I've been doing it for 20 years, but I've been really watching the markets probably for a quarter of a century. And so I have a list of companies that I respect for various reasons. And that list is a living, evolving list. So some companies come and go, they change and evolve. But it's a list that I'd like to own at some point. It's that gas station or whatever business that you have in mind that I'd like to own at some point. And I can be very patient. I have this little exercise that I propose now and then when I give talks or I work with interns, and I say, you showed me the 5 stocks you'd like to own. Out of curiosity, can you look back and see the price range of those stocks in the last year, 3 and 5? And so many people are shocked that the companies that they think that this is the best thing of today, they actually traded in a range that sometimes it's like from 20 to 80 or from 10 to 50 or these are wide ranges. And why is that? Because the market goes through its own ups and downs, but individual stocks and sectors go through their ups and downs throughout the year. And some very respectable businesses trade in a price range. And if you could wait and buy them at a lower point, you get many benefits. One, obviously the returns will be better because of it. Then I'm obsessed with the risk. So if I pay less and I'm wrong, I'm going to walk away with a smaller loss.
Yes.
And you're not running the risk that you're buying something that has all the upside priced in. Somebody was giving a story that I've heard 1,000 times. I want to say it was McDonald's, but I don't remember. But it rhymes with so many other stories. Over a period of time between 70s and early 80s, how McDonald's went from a very high multiple, like a tech multiple we would say today, I think was 80 times, to 8 times or so. I think it was McDonald's, but I'm sure it happened to Walmart and Coca-Cola and everybody else in between. And you had a period when the business was growing double digits, I think 20% or so. But the valuations got compressed by 80 or 90%. And it's the part that people don't appreciate enough. When Jeff Bezos, we talked about Amazon at the beginning, and it's no recommendation, nothing, just a case study from 20 years ago when the stock went from 109 to 9. And Bezos was embracing and understanding the animal that the stock market is. He said, well, the business is doing well. I'm looking at all the metrics. People can look up that letter that he wrote.
Mm-hmm.
So the metrics are doing well, the fundamentals as we speak in our language, right? But he says that the stock just went from 109 to 9. But that's what the stock market will do. And that's the valuation side, right? If you pay so much for the earnings or expected earnings, don't be surprised that the market can turn on you, and even a well-selected stock can be poorly purchased, and that can lead to very disappointing results. So that's something that I pay attention to. I have the mantra that I mentioned, down, cheap, out of favor. I have a list of businesses that I want to own, good business, good prospects, good management, and I'm willing to wait until the opportunity appears and the stock is off by 30-40%. It's cheaper, and I really like when the enthusiasm is toned down and people are out of it, people are a little bit concerned, but I have to have conviction and understanding that whatever is happening is a temporary issue. It's a couple of quarters that were missed. It's a product issue or delay. It's something that's fixable, but has not made any permanent damage to the business. That's the dance between temporary and permanent. It's the hardest thing, but you have to keep on judging, is this a temporary issue, and if it's a permanent. If you realize you were wrong, correct that. And one or two things I want to mention. I think in our world, people are obsessed with catalysts. And I was in a meeting, and it was not long ago, and it was a company that I respect, and I won't mention which one, but somebody in the audience talked to me after that, and he said it's not investable in his world. And I said, why it's not investable? Because we both respect this company. He says, well, you can't identify the catalyst. And catalyst, it's a word that's used a lot. That means that I know exactly what will move the stock. And I don't know. I just know that it's a quality business that I got at a very good price. But catalyst means that I have some sort of a foresight into what will move the price in the foreseeable, as in 3, 6, 12 months. Mm-hmm. I don't know. So I surrender the catalyst part. I don't have it. I just know that I bought something, it's a good deal, and I'm willing to wait. And the second part to it, which I threw out the window a long time ago, but a lot of the colleagues in this industry are obsessed about, is price targets. I don't use price targets. I don't. I want to own it forever if I could, right? That's the aspiration. If it's such a great business, it's ubiquitous, global, and it's got profits, I want to own it for as long as possible, as long as the story holds, right? So price targets, I think, are a huge impediment in our thinking, because if you bought something at $20 and you put a $50 price target on it, what happens at 50? You go through a tremendous psychological, challenge, revolution here, because you're thinking, on one hand, yes, I was right. On the other hand, why would I continue to hold it? It's like you said you're going to Rome. You are standing in the middle of Vatican City. You are in Rome. Where do you go next, right? It's you got to 50. But that stock could be 100. It could be 200. It could be 500, right? Like it could be much bigger. It was in 50 markets. Now it's in 100 markets. It had 2 product lines. Now it has 7 product lines. And the new product lines are priced higher than the ones that they had before. And they found cost savings. So they're actually making 3 times as much per unit, and on and on and on. You and I know that. So why would you have a price target? So if I can propose something, it's very helpful, and it's a secret. So for the people that are listening so late in the episode, but catalysts might not be as helpful as you think, and I think price targets could limit your imagination on what this investment could do for you.
It's almost impossible to capture, imagination, to model optionality. I know there are option pricing models, and there's tools that can help, but it's very hard to model true optionality in a business that 20 years ago, case study, Amazon, no one was modeling that it was going to be the largest hyperscale infrastructure cloud service in the world, right? That didn't really exist at the time. And then since then, they've layered on other lines of business as well, and they've just stacked growth curve on top of growth curve on top of growth curve. And so it's very, very challenging to do. I also don't think about catalysts. I don't spend 1 minute thinking about catalysts. So you want to buy them when they're down, cheap, and out of favor. I recently interviewed someone, Steve Scruggs. He's a 5-star rated gold, star rated small cap value investor from FPA, and he has a saying: "We look down before we look up," because he wants to limit the downside. He wants all of the risks to more than be priced in, and that leaves the potential for a lot of upside. That's why he looks down first. If he looked up first, all that upside could be priced in. And so I love your saying equally as much as his. Down, cheap, and out of favor. To me, they mean the exact same thing. They're synonymous. He looks down before he looks up. What keeps you up at night?
I'm making sure that fewer and fewer things keep me up at night.
Good.
I spend a lot of time thinking what's within my control and what's outside of my control, and it's a practice, and it's been practiced by many before me. I think it's part of the Stoic mindset, but I think it's universal in many ways. And I could worry about many things. I could worry about the direction of the market. I could worry about the surprises within my portfolio and so on. So what can I do to handle that, right? So eliminating a lot of things has helped. Knowing what I own, actually knowing what I own. And I think that's the beauty of my pursuit, that I know the clients I work with. I know the names, the families, the stories. I'm very close to them. And I know the businesses that I hold. I don't know if I know them inside out, but I know them as much as I can know them over the years of research and study. And as a public shareholder, I have to emphasize it. We are all public shareholders, right? So we know as much as we're allowed to know. But I have a really good understanding of who is running them and why and in which direction and so on. So at the end of the day, I'm trying to eliminate any situations that if there's a negative surprise, it's not disruptive. And it's the bigger idea of, we talked about what is it that you don't want. I had Luca Delana on the show, who is I would call him a business philosopher, but he talks about game overs. He says it's not the fastest skier that wins the race, but the one that participates in all the races and is the fastest out of all the ones that survive. And that kind of a survival mindset is very important. So when you run a business, when you run a portfolio, when you manage money, even when you lead your own life, what are the things you could do to avoid a game over? A game over would be a total loss. A game over would be, loss of reputation in business as well, and so on. So what are the things you can do to minimize or completely avoid that and not participate in those situations that could cause damage that you can't beyond repair? And the benefit of owning a portfolio of stocks is that, if you have more than a handful of them, and I think studies show that over 20, you're kind of diversified away a lot of the risk, and there are layers to it, right? So if they're all in the same industry, it's not diversified. We have to say that, right? And if it's 20, but you have half in one stock, it's not diversified, right? So you have to be thoughtful about it. Yep. But if it's a diversified in the sense that they're from different industries, they all have solid balance sheets, they are in solid businesses, they're doing something right, the market will go up and down. And I have no idea where the market will close for the year. I have no idea. But it's not that important if you know what you own and why. We talked about it to some extent, but the beauty of owning a public equity stocks is that you can buy and sell anytime you want, but you're not the only one that has that ability, which means that the price will be dictated by those that get too happy or too upset, panic and too enthusiastic at times. But that creates a buying opportunity or even a selling opportunity at times. So you have to accept that you're going in for a ride. And for a lot of people that spend their life in private businesses and never had a price quote for their business, it's a very disruptive thought. We talked about families transitioning from a single business to multiple businesses, a stock portfolio, but it's also a transition from a family that has had a business for 20 years and never knew how much the business is worth. They only knew the cash flows that it's, $1 million or 2 or 5 or 10, whatever. But they didn't know that they're worth $200 million. They didn't know
Mm-hmm.
that, right?
Mm-hmm.
Nobody's
Mm-hmm.
calling them every day. Well, maybe an eager banker.
Mm-hmm.
But once it's turned into a portfolio, a $200 million portfolio, you call me today, it's 195. And you call me tomorrow, it's 187. And then you call me next week, it's 205. And that gets to you. And I think having this ability to be comfortable with the fact that that paper net worth is moving around, but you know what you own, you know why you own it, and you will continue to own it. I think that's where magic can happen, and you can actually participate in it. If it gets to your head and you try to outguess it and you have a lot of discomfort around it, I think it will get you in trouble with a small amount or a large amount, because you're trying to tweak and you're too eager to change, you're too eager to get out, and on and on. The beauty of the stock market is really that, and you and I know that you get the best deal when most of the people are uncomfortable going in. That's the rule. And some of us smile and love it, like you and I do. Like if the stock is off by 50% and there are a lot of people uncomfortable with it, but there's a reason to own it over the long period of time, I'm very excited about it. But if it's something that makes you uncomfortable, you have to be honest with yourself and either have somebody else do it for you, or maybe not do it yourself. I think that's the decision you have to make, if it's okay. And I see people that have done incredibly well in the private market without a price quote and are really struggling in the public market. And I think
Absolutely.
you have to be honest with yourself that it is a different animal. You do own businesses, but you do get a daily price quote. I take advantage of it, and I hope you can too. But don't let it get in the way of what you're trying to do here. I think that's key.
Let's finish with this, Bogumil. What is your happy place?
What's my happy place?
Yeah. The beaches, the mountain, a coffee shop, your office, the walk you go on. What is your happy place?
I love nature. You brought up mountains and the beach. And so I love nature. And when COVID started and I was in New York, and New York was not fun at the time, and it was a hard period for the city and for a lot of people, but we would go on walks along the river until the police asked us to go home. And it's a very memorable time. And it feels so far away. But being able to be outside, and we went on hikes at the time, and we tried to get out and be in nature. I think as humans, we need to be surrounded by nature. There are terms, forest bathing, I think it's something like that. I think there's some concept that we have to be surrounded by nature for a period of time. I think that's where our mind and body and soul cleanses. So being outside in nature among trees with birds, I think that's a huge benefit. I don't know if you know the story, but during COVID, Megan and I picked up and left New York, and we stayed in a cabin in the woods. And I have very fond memories of that time. It was a very small little wooden thing. I think it was a hunting cabin that somebody built in the 50s. Maybe it's the size of a tiny home, but we didn't care. We were outside. And I was taking one of the calls from outside, and I had lawyers. It was a serious call. But it was also a time where I felt like I have to take care of myself. So I was sitting outside, and it was a serious call about some estate planning for a family. And one of the lawyers says, "Who has all the birds with them?"
That's me. Yeah.
And that was me, because there were birds all around me, and it was springtime, and the birds were going crazy. And you never know how much the phone picks up until somebody tells you I can actually hear it. But he said, "Oh, this is the nicest sound I heard all day." And I thought we all need that. So this is my happy place, to nature, peace, quiet. And I think that's where my brain gets a break, and that's when I rest. But the funny thing is, you said you don't bring technology with you on your walks. When you come back, don't you come back with like 10 new ideas from that walk that you have to write down as soon as you get home?
I go right to my phone and write them down in a note on my phone as soon as I get home. Phone, because the phone is easier for me to get into than to get to my desk, get onto my computer. I just start typing into my phone as soon as I get home. Yeah. And the truth is, I probably lose some of them on the walk, because I'll have this great idea and then I'll look at a bird, right? Or we have these turtles that are just wonderful to look at in Audubon Park. And my mind will wander, and Every once in a while, I'll probably lose the idea. But yeah, nature I think it's important to all of us. All
What
of
do you
us.
do when you lose an idea?
Um, I don't panic because I tell myself if it was that good, it'll probably come back to me. I mean, like you, I'm pretty devoted to this craft, and I spend a lot of time reading and thinking and writing. And so during that process of just reading and thinking and writing, a lot of times I'll be deep in thought writing one thing, and then that idea, whatever it was that was lost momentarily, will come back to me. And then I'll open the other file that that idea relates to and quickly jot it down before I go back to what I was doing before that. So I don't panic if I lose an idea. Jerry Seinfeld, really quickly, you probably know, a lot of the listeners probably know, he carries around a little small notebook everywhere he goes, and a pen or a pencil, whatever, a writing implement, so that whenever he gets an idea, he can write it down immediately, so he doesn't forget it. Yeah,
I
but
have
yeah. Sorry, go ahead.
now I have this image of I think it's from an old movie or a book, an older gentleman dressed in white carrying a net and catching butterflies around the field. And I feel like ideas sometimes are like that. You know, they come up to you and then they fly away, and they come up to you and they fly away. One of the tricks that has worked for me is to go back to the exact same spot where the idea came to me. And it's funny how many times that idea will pop back in. It's almost like that idea is suspended in time and space. Like
Right
in
where you
those,
left it. Right. Yeah.
exactly, like in those old computer games. I haven't played a game in a while, but where you have the little medallion or something lingering in space, and you have to go back to walk through it to collect it, get points.
Yeah.
It's kind of like that. The idea is suspended in time and space, and you can go back to it. But I've gotten better about creating those nets, whether it's on the phone or anywhere, where I just write it down because I feel like it came to me for a reason.
Hmm.
It could be an idea for an article. It could be an idea for a question. It could be an investment idea. It could be a better solution for a client about something that I've been pondering about. And it's pretty random when those ideas come to me.
Very.
And allowing yourself to find time and way and a system and a structure to maybe a net to capture them, because they came to you for a reason. You thought about it for a reason. So I like to respect that.
Definitely. Definitely. Um, so I'll close with a story. So you asked me to read something, and I emailed you that when I finished reading it, it brought a tear to my eye because it was so good. It was nearly perfect, and there was beauty in it, and I could see the not just the time and attention and effort that you put into it, but I could see the love that you put into this piece of writing. Um, and I also told you that I was serious when I said that I aspire to be like you, Bogumil, in so many ways. So I'm going to leave it at that. Thank you for trusting me as the host of your show today. And until next time, take care, my friend.
Well, John, I'm speechless. I want to say thank you for this time and all the questions. And I'll just mention that the piece that you talk about, it's the owner's manual that I'm writing for Blue Infinitas Capital, which is the new firm that I launched a few months ago. And I shared it with you because I knew that you will have some thoughtful feedback. And it was a very, very vulnerable piece that I told you that I wrote. And it's my message introduction to anybody interested in what I do that will be ready soon enough, hopefully by the time this episode is out there. But I realized that there's all kinds of writing, all ways, different ways of communicating, but I've grown more comfortable being more vulnerable about sharing what I'm about. And I think that's something that's empowering and overwhelming at times, but I think that's how we connect. And that's how we allow people to get to know us. And that's a piece that explains why I do what I do and how I do it and who I do it for. And it's much more than, it's a calling for me, what I do. And I think I feel very, very fortunate and blessed that I get to do it and serve people in this way. and deploy all my curiosities as I'm doing it. But I'm no longer doing it for a paycheck. I don't think of it that way. I think of it as there's this incredible opportunity to help people in so many ways. And I've learned and I've seen so much, and I'd love to share it. So that's the piece that you mentioned, but I appreciate you bringing it up. Thank you.
You're welcome, and I feel fortunate and blessed to know you, to be friends with you, to learn from you. And using the net metaphor, as soon as we get off this, I'm going to go write down ubiquitous, global, and profitable, and down, cheap, and out of favor. Thank you, Bogumil.
Thank you, John.